Welcome back, everyone. We're doing episode 2 of the HP Value Investing Show. And in this video, we're talking about GameStop because everyone's talking about it these days. And we felt that there's a lot of talk about kind of just the situation, but I haven't seen much analysis of the actual company. So that's what we wanted to do. So should we just jump right into it?
Let's talk about GameStop and what they do. So GameStop, they sell video games, so either physical ones which you can go into the store and buy. They also sell accessories, so headphones, keyboards, things like that. And they also sell other accessories and collectible items, as well as consoles, so PlayStations, Xbox, things like that. I think that covers most of it, right?
Yeah, they sell, and just to highlight, they sell new games and used games. So we wanted to show you this because, as you can see here, from the beginning of 2021, the share price had a massive spike when there was this whole Reddit situation. That's only on a 2-year basis, but if we look at on the max basis, you can see how massive this spike is compared to its history. And we wanted to bring this up just to put into context how extreme this recent situation actually is. Right, so now we are looking at the business tenets, and we look at 4 tenets, which are the 4 tenets that Warren Buffett uses when he looks at a company, which are business tenets, management tenets, financial tenets, and then value tenets. So this is the first one, the business tenets. And oh, by the way, if you like this video, then like and subscribe it and share it.
Like and subscribe.
Yeah. People say. But anyway, yeah, just to kind of give a quick overview of the business tenets. It's just a few points here we wanted to point out, which is that, first of all, the revenues peaked in 2012, which is generally not a good sign when you see that revenues have peaked and they haven't. They're making less and less money every year. That's not a good sign. And then also their operating margin, that also peaked in 2009, and it was kind of a little bit stable, sort of going down a bit, but then it took a dive in 2017, and that's also a bad sign.
We don't think they've got that much in long-term prospects. Nor do we think they've got a competitive advantage. As you already mentioned earlier, they like to sell physical games, or they've tried going down the download market, and realistically speaking, they're just being outperformed. You can't say outcompeted, but outperformed by the likes of Amazon, eBay, video game vendors who can where customers can just buy the games directly from them. So again, Xbox, Sony, those sorts of that sort of competition we're looking at here. And GameStop, they don't appear to have any kind of strategy out of this either. Such to the point that towards 2018, I believe, GameStop they explored whether they could sell their company or not, and ultimately they never found a buyer. And furthermore, they're also closing stores. If you have a look at the numbers, or if I look at the numbers and share them with you, over the last 5 years, they've cut down the number of stores by about 10%. So just to give you some numbers here, 2016, they had about 6,000 stores, and February of 2020, looking about 5,500 stores. So you can see the numbers steadily dropping year on year.
Right, so we're now moving on to the management tenet, and we usually put a big focus on management because we think it's really important. It's just that in this situation, GameStop doesn't look like that much of an interesting company, and they've had different changes of CEOs lately. There's one that had been there for a while, and then he stepped down due to health reasons, and then there was another one there who was there for only a few months, and then he left without saying why. And then I think the chairman had to step in as interim CEO, and then there was another one, an interim CEO or something, and then they got a new one. So there's been a lot of changes. So for this analysis, we're not actually focusing too much on the CEO element because there have been so many changes in CEOs, and we don't know if there's going to be a new CEO soon. And just given the kind of the situation that GameStop is in, we don't feel that the management is that interesting because we think it's difficult to turn this ship around, and no matter how good of a CEO you are.
Yeah. Now we're going to look at the financial tenets, starting with the return on equity. Return on equity is important because if you're an equity holder, you basically want to see a return on the money you've invested, right? So if you have a look here on this ticker screen, we can see that the return on equity for GameStop is largely stable until 2018, where you can see it's taken a massive dive and it doesn't appear to have really recovered. And there you go, just zoom there, or hover over rather, you can see we're getting negative return on equities for 2019 and 20. When we dug into this, we saw that this was because of a massive decline in goodwill. Lars, do you want to cover what goodwill is?
Yeah. So goodwill is when you buy another company and you pay more than the value of the assets, and you pay more because you believe that the company you buy, maybe they have like a brand value or something like that, so you need to pay up for that. So you put that as goodwill on the balance sheet, and if you believe that the value of that goodwill has decreased, you have to write it down, or you have to impair it. And that's what it seems like GameStop did. The value of the goodwill was dependent on the future earnings of the brands and of the company, and they believe that that value decreased, like the future cash flow they would get from that. So they had to adjust down the value of that. So you had to write down the goodwill. So basically they thought, their assets were worth much more than they were. And then they realized, oh, they're actually now worth way less because our business is doing so poorly. So now we have to write that down to reflect the fact that our business is doing very poorly. So it's not a good sign. So it's kind of another piece of evidence that the company isn't doing that well.
Yeah.
So I guess from that, we're moving on to, we're talking about the free cash flow, aren't we?
Yep, that's right.
So I think let's just we're on ticker here and looking at the free cash flow. So free cash flow is basically cash from operations less the capital expenditures. Capital expenditures is cash you have to invest in the business to kind of keep it going and also to keep it growing. So let's just remove the return on equity. We can see the free cash flow going back, or the free cash flow is this orange one minus this one, the purple one. But basically what we're seeing is that the free cash flow peaked in 2000, or the cash from operations, this orange one, peaked in 2014, and then it's sort of slowly declining. So the actual cash that they're taking in from the business is just going down and down and down. Because also just the last thing we want to look at here with the financials is that if we look at let's go back to the income statement, and then I think we mentioned operating margins earlier, didn't we? But we just want to touch on that again. Let's remove this one, and again, we like companies with high margins. You can see I guess, what is that, green, or maybe it's teal? What do you think?
Teal.
Oh yeah, that one is it's 6-7%, which is not great, and then the net margin is also not great. So that means that basically they sell products, but they don't keep much of that money. If you sell a product, you want to keep as much of the money as a profit, but they're not doing that. And then again, with the same story, it's kind of going down in 17, 18, 19, and 20. And this is all happening before the pandemic. So the problems were already there.
Yeah. And again, I believe that year you're looking at there, is that mainly down to the the drop in goodwill that's impacted your net income.
Yeah, correct. I think that bit. Yeah. As we're looking at now the valuation of the company, and this is a bit tricky one with GameStop because they're they're losing money in the last few years, and in 2020 the free cash flow was also negative. However, the last 12-month numbers, the free cash flow is actually positive, so it's about 200 million, and then the capex is about 50 million. So the free cash flow is then 200 minus 50, which is 150. And then we just applied a 0% growth rate to that, and then a terminal value growth of 2%, and then a discount rate of 10%. And we basically came to that the value of the share price, not the value of the share price, but the fair value per share is about like 40, 43 or 44, something like that. I would say. And what was the price now? We looked at the price recently. It is something like 50 or 40 now, isn't it?
Yeah, that's right.
Something around there. And based on that, you kind of say like, oh, it looks like it's fair valued. However, we used a 0% growth rate, which is probably not good, not fair, because they're actually they're shrinking. So you probably should use a negative growth rate. And also the free cash flow numbers is so like up and down, so it's very difficult to say. So this is one of those like valuations that we find kind of difficult to do because it's not a very stable company. And so yeah, if we say the fair value would be around 43, if there's no growth, I think it's probably lower than that. But I think in terms of just because we looked at the company and it's not the greatest company, that we wouldn't invest anyway. So the valuation here isn't that important, and so I think even the 43 or 44 is that's probably too high for that company.
That covers all of our analysis. So this takes us nicely into the conclusion, which is, would we invest in GameStop or not? And the answer is no, we wouldn't. The financials are quite weak. The industry is declining. And even when you try to place a fair value on the business, it's just not at the right price. It's it's too expensive. And even if it did become cheap, it's just we think it's just a low quality business, really.
Yeah, there are better businesses out there, so we wouldn't spend our money on that. And I think just kind of to also, I think it's important to highlight that these are just our opinions. Like, we're not giving investment advice here, because a lot of people are in different situations, and maybe if they bought at different levels or whatever, and they might have some insights that we don't have. So we're just kind of presenting what we
found.
Yeah, exactly. Yeah, and it takes into account our own process as well, because we have other companies that we're looking at the moment, and it'd be way more interesting to invest in those companies. We think they have a way brighter future. So you kind of compare it to the other opportunities out there. So.
And one last thing is, be sure to go to our website, so at www.hpvalueinvesting.com, and please subscribe to our newsletters there. And finally, we also have an account on eToro where you can copy our portfolio. So here we are on eToro.com, and all you need to do is, under that search bar at the top, if you search for HP Value Investing, just as you can see it there on that screen, that should take you to our profile, and you should be able to copy our portfolio from there. And if you need any help, of course, again, feel free to contact us, and we can help.
Yep. All right. Thanks, everyone. Thanks for watching.
Yeah. Thank you. And until next time, bye-bye.
Bye.